Well, good evening. As director of the Belfer Center for Science and International Affairs, it's an honor for me to join in welcoming Arthur Levitt, chairman of the Securities and Exchange Commission of the United States government. This is an event that has been a long time coming. Arthur and I have been in correspondence for more than 2 years, I think now, about this event, but I'm especially pleased that he's been able to squeeze time out of his schedule for us here at the university and for other guests from the Boston financial community. For a school of government, the role of the SEC and of an active leader of the SEC like Arthur Levitt is fascinating. It provides an instructive case study of what we are about here as a school of government. Several members of the audience here were present last week when I hosted an event for Dmitry Vasilyev, who's Arthur's would-be counterpart in Russia. As one reflects on the collapse of the Russian stock market during the past year, or on the collapses of other emerging markets like Indonesia or East Asia, or even the uncertainties about Latin America, it's clear that failure has 1,000 fathers. But as the great crash of American markets in 1929 showed, one significant cause of failure can be the absence of appropriate government regulation. Let me say it again, the absence of appropriate government regulation. What can we predict about a totally free market? That is a market altogether free of government regulation. I would say answer, massive abuses, occasional bubbles, inevitable collapse, and most importantly, loss of confidence by investors without which no viable market can succeed. So it's a special pleasure to have talked to us about the special role played by the SEC in American markets and an instructive lesson for those of us students of government and business alike. It's also especially appropriate since here at the school under Joe Nye, the dean, we now have a project on governance in the 21st century in which we're trying to ask questions about this delicate balance between private initiative and the role of government. So let me turn this over to Joe Nye.
Thank you, Graham. It's a pleasure to introduce Arthur Levitt, who in July 1993 became the 25th chairman of the Securities and Exchange Commission, and in April of this year was unanimously recommended for a second term as SEC chairman by the Senate Banking Committee. He had a long career in Wall Street, 16 years, and became president of Shearson Hayden Stone, which eventually evolved into Shearson Lehman Brothers. Was chairman of the American Stock Exchange from 1978 to 1989, and was chairman of the New York City Economic Development Corporation from 89 to 93. He knows his business well, which is why we want to hear from him. But I should say that he has another side. He is also an avid outdoorsman who leads an annual outward bound expedition composed of senators, cabinet officers, educators, and other notable figures, and told me that just this weekend he caught a 5-pound striped bass, which made me duly envious. Arthur has offered after his talk to answer questions on a wide-ranging set of questions, not only what he will address, investing, Social Security, in the stock market, the SEC's perspective, but what it's like to go from business to Washington, what it's like to be in Washington today, or any other subject that we wish to raise. So please join me in welcoming the Honorable Arthur Levitt.
Thank you very much for that wonderful welcome. This is a great experience for me to be at this wonderful institution on whose advisory board I served for a number of years, and to be up at Harvard is, for someone who comes from Brooklyn, New York, is kind of a pleasure. Before I left Washington today, a friend called me and urged that I ride the Red Line into Cambridge. And I asked why, and he said, well, you'll see. Well, we were waiting for the train, and I noticed more than one sign that said, "Danger, third rail." I called my friend and said, are you afraid about what I'm going to talk about tonight? Are you warning me not to touch the third rail of American politics, Social Security? No, he responded. And why'd you want me to take the subway, I asked. He said, because it's the only way to avoid the big dig. Well, for anyone who works at the SEC, coming here to Harvard is very much a pilgrimage. It's no exaggeration to say that Harvard University produced the founding fathers of the laws that regulate America's capital markets. Early in 1933, President Roosevelt asked Felix Frankfurter, then a professor at the law school, to come to Washington and write the nation's first securities legislation. Frankfurter brought 3 of his Harvard associates, John Landis, Thomas Corcoran, and Benjamin Cone. By the end of 1933, each would become a national celebrity and a symbol of the New Deal. Drafting this historic legislation was by no means an easy task for what was known as Felix's happy hot dogs. The competing forces of Capitol Hill, the courts, and of course those within the industry, tested the group's intelligence and their patience. But they kept their focus on 2 important goals: to increase both investor protection and investor confidence. And it's only fair to say that they succeeded. Today, America's capital markets are the envy of the world. Their resiliency, transparency, and efficiency stand second to none. A culture of non-disclosure has been replaced by full disclosure. Reckless self-interest has been tempered by the public interest. Today, I'd like to talk to you about the SEC perspective on investing in Social Security in the stock market. Few dispute that Social Security reform is essential. Social Security benefits are projected to exceed revenue from payroll taxes within 15 years. By 2032, the Social Security Trust Fund is widely expected to be totally depleted. 3 basic options exist to close the gap between benefits and revenue, and thereby extend the total life of the trust fund. 1, reduce benefits. 2, increase revenue. Or 3, raise the expected rate of return by private sector contribution in terms of investment in the stock market. Not surprisingly, almost every reform proposal involves some sort of market investment. For the most part, these proposals draw on 2 basic ideas: having the government invest the Social Security Trust Fund in the stock market and allowing individuals to take a certain percentage of payroll contributions in an individual private account. Now, I'm not here tonight to support one plan or another, nor do I assume that some sort of private sector investment is absolutely inevitable, but it certainly is being seriously considered. Earlier this year, the President called for a national discussion on Social Security, and I think this is absolutely the right time for the SEC to outline areas that have specific relevance to our responsibility, our experience, our expertise. The SEC's fundamental mission, our obsession, if you will, is the protection of investors. And the potential for investing Social Security in equities raises important issues that go to the very heart of investor protection. This mission, above all, will guide the SEC's thinking as the discussion moves forward over the course of months and years ahead. What we are talking about today is nothing less than a watershed event in how Americans think about retirement security. That security has been traditionally built on three pillars: Social Security, private pensions, and personal savings, each with varying risks and varying returns. We have an obligation to think long and hard about the implications of Social Security reform. Investing Social Security in the stock market, by its very nature, involves heightened obligations, difficult questions, and new and great challenges. Increased risk through greater choice obviously holds the potential for greater returns. But uninformed investors often won't be in a position to capture that potential. They risk making poor investment decisions, perhaps even because they fall prey to fraudulent advice or misleading sales practices. Regulators are simply going to have to commit greater resources to combat a potential, almost an obvious, increase in fraud. They'll also need to have to work very hard to ensure that costs to investors are effectively disclosed. The intersection between corporate governance and government influence may become far more complex. Let me first talk about investor protection. Specifically, as far as I'm concerned, our nation faces few higher economic priorities than maintaining the integrity of our markets, maintaining the sanctity of the numbers that investors and analysts rely upon before they make investment decisions. The premium for risk is lower in U.S. markets than any market in the world because of the reliability of the numbers, because of the reliability of the system. Without that integrity, that fragile cornerstone of our markets, investor confidence crumbles under the weight of uncertainty and doubt. But a greater influx of new investors can sometimes test that integrity by providing more opportunities for fraud. That's something we have to consider importantly in terms of the Social Security debate. Some proposals here in the U.S. would have the government administer Social Security accounts with limited investment choices. Others would have accounts held with private firms, providing individuals a much, much broader range of options. But it is likely that giving people the ability to select investment options will provide the unscrupulous with new opportunities to deceive and to distort. If we're to have self-directed individual accounts, we must be ready to undertake an unprecedented level of broad-scale policing of our equity markets. Without such policies, fraud and sales practice abuses may be perpetrated against an army of new and relatively unsophisticated investors. And many of those new investors are among our nation's most vulnerable citizens. One need only look at England's recent experience with Social Security reform. In 1988, the UK allowed individuals to opt out of their national pension system and into private accounts. In what has become known in the UK as the mis-selling controversy, high-pressure sales tactics were employed to persuade people to switch into unsuitable personal pension schemes. Thousands of salespeople were out there hawking investment options that were unconscionably fraudulent. Sales agents often sought too little information from potential clients, many of whom were teachers, miners, and nurses, to be able to give them even the most primitive guidance. And in too many instances, They gave investors wrong and, what's worse, biased advice. These abusive practices, coupled with inadequate regulation, led to literally billions of dollars of losses for investors. We need to consider how to promote sales practices that benefit everybody's interests while preventing those practices that hurt investors' interests. Let's take advertising for a moment. I have frequently criticized the focus on performance in mutual fund advertising. I worry that the fund industry is building unrealistic expectations through performance hype. While I'm encouraged by progress in this area, it would be unfortunate to see a similar cottage industry created under a system of individual Social Security accounts. We simply cannot afford to instill in millions of investors the proliferation of short-term gain kinds of thinking at the expense of long-term solid results. That's not what Social Security is all about. That's not what our system is all about. And it's one of the things I think we have to change in this country in terms of short-term results, short-term thinking, rather than a strategic view of investments. Today, more and more of us are taking responsibility for our own retirement needs. The internet and other developments in technology have put a wealth of information at the fingertips of investors. No universe of investors in the history of this country has ever had available to them more information from more sources than we have today. In many respects, an era of institutional reliance is ending. An era of self-reliance has begun. But the consequences of mistakes are more onerous today than ever before. The velocity of instruments that are out there today and the consequences of misusing those instruments, misunderstanding those instruments, is far greater than any of the instruments we had in the past. And the globalized market opens up opportunities and risks, which makes planning an absolutely essential ingredient of any kind of investment advice. Back at a time when most of us saved at a bank, bought whole life insurance, or had a defined benefit plan, the responsibility for investment was in someone else's hands. But that's no longer true. By entering the less certain world of international capital markets, more than 50 million American investors have assumed higher risk in the hope of earning higher reward. Now they must assume even greater personal responsibility. There is an absolutely unacceptably wide gap between financial knowledge and financial responsibilities. Closing this knowledge gap is among the most important issues we face today. It becomes even more of an imperative if Social Security becomes privatized. I believe that there is one word that every person in America has got to understand, and that's risk. I am astonished at the failure of most Americans to correlate risk and reward. What greater example could you have had than Orange County, where every other community in the nation was offering 3 3/4, 3 7/8 return on similar funds, and Orange County was offering almost double that. And investors chose to turn the other way. Risk is an absolutely indispensable part of our capital markets. Markets go up and markets go down. Certainly the last few months have reinforced that point. But at least based on historical performance, investing over the long term is relatively sound and safe. Investors need to understand the relationship between risk and return and the benefits of a diversified portfolio. This is a critical element of making suitable and sound investments at the right time in their lives. Simply put, managing risk has to be a key part of any plan to publicly invest Social Security. And understanding risk must be a key part of every investor's education. There's another word every investor in America needs to understand, and that's cost. Investing in our markets costs money. Executing transactions, sending account statements, even switching investment managers entail expenses that are ultimately paid by the investor. And fees sure matter in terms of investors' bottom lines. A 1% annual fee will reduce an ending account balance by over 17% in 20 years. The SEC has worked with the mutual fund industry to help ensure that these administrative costs are properly and accurately disclosed to investors. But we sure have a lot of work to do yet. Our research shows that only 8% of investors say they begin to understand the expenses charged by their funds. Now, consider a system of 140 million individual accounts, one for every American worker. Some plans would put 2% of the payroll tax into an individual account. But for the roughly 40 million workers who earn less than $8,500 a year, that equals only $170 or less per year. This is not a lot of money from which to build up a portfolio, and administrative costs will quickly eat into any higher return from individual accounts for lower income workers. These issues require thorough and detailed questioning. Should the fees, for instance, be a flat amount per year, regardless of the size of the account, or a percentage of the account's balance? Would private firms even find it profitable to offer accounts to this large number of workers? Would private firms be forced to open accounts for any workers that chose to have them? I bet that right now many of you are thinking the same thing. If I wanted to hear a bunch of questions rather than answers, I would have gone to class. Unfortunately, I found that there are very few quick and easy answers to these issues. But we can look at other countries' experiences for guidance. In Chile, considered the grandfather of Social Security privatization, one study found that fees shaved almost 1/3 of the annual return in the first 10 years of the system. And 1/3 of these fees came from marketing and sales costs. This is not surprising, since another report found that there were more than 20,000 selling agents going from house to house marketing accounts. Consequently, 3 out of 10 Chilean investors switch fund companies every year. Administrative costs are also tied to the range of investment options available to investors. For example, some have proposed individual accounts administered by the government that closely resembles the thrift savings plan for federal employees. Investment choices would be limited to broad market indices, thereby reducing administrative costs. A privately managed system, on the other hand, could offer individuals a much greater range of financial choices, but with higher administrative costs. Thus, there'll be likely a trade-off between greater choice and lower fees. But today, there is a trade-off between ignorance and opportunity. Unfortunately, over half of all Americans don't know the difference between a stock and a bond, and only 12% know the difference between a load and a no-load fund, and only 16% say that they have a clear understanding of what an individual retirement account is. And this is even more troubling when you consider the new complexities raised by Social Security reform. For example, the current Social Security system provides an inflation index benefit no matter how long you live after retirement. In an individual account system, investors need to recognize that they risk outliving their savings or seeing them eroded by inflation. That's why some proposals would force new retirees to exchange their lump sum savings for an annuity that provides a guaranteed payment over a retiree's life. These potential investors will have important decisions to make, and they really need the tools to make them. The government can have all the resources and power in the world to protect investors, but such power is useless if investors don't understand the basics of savings and investing. No matter how perfect the plan is to reform Social Security, it won't be nearly as effective as it could be if investors understood their options. However Social Security is reformed, we know that we cannot lose any time in increasing investors' education. Now, how can we do it? The SEC and a national coalition of government agencies, business groups, and consumer organizations have launched the Facts on Saving and Investing campaign to begin to encourage Americans to get the facts they need to invest wisely and to save wisely and avoid costly mistakes. We started a program of investor education town meetings around the United States. We started it 5 years ago in Cherry Hill, New Jersey, where 30 men and women came out to ask questions about investments. Today, we have about 6 of these town meetings a year, the most recent of which was in Los Angeles, which attracted 7,000 people who came out for 2 hours to ask questions about their investments. Routinely, thousands of people care enough about this issue to ask questions. There's something going on in America that I don't think we've taken adequate note of. The sad fact is that most Americans have no idea how much money they will need in terms of facing retirement. They're frightened by going through a net worth statement, of conjuring up what they will need to support them in their retirement years. And there's something psychological which makes them push it away. 55% have never even tried to figure it out. Let's try to help them. I want Americans to hear more about the importance of saving. Companies should take a greater role in teaching workers about saving. It's certainly in the interests of both companies and workers. In addition to investor protection and investor education, another aspect of Social Security reform includes the impact of government investment in capital markets. Those who favor having the government invest the trust fund in the stock market point out 2 obvious benefits. First, it allows that market risk to be spread across society and even across generations. Second, given the economies of scale that the trust fund could achieve, administrative costs would be significantly lower than for individual accounts. Just imagine the cost of a brokerage firm, a mutual fund, an investment advisory firm, having to administer accounts as small as several $1,000s a year and send reports and do valuations. But I know that some, including Chairman Greenspan, have raised strong objections to the government owning stock in public companies. They point out that this could lead to political interference in deciding in which companies to invest and how those companies are run. Could the government invest, for instance, in a tobacco company? What about a company that was a toxic polluter 5 years ago? More broadly, assuming the government invests in individual stocks as opposed to market indices, would it be able to vote its shares? And if so, how? Now, Canada may offer us some lessons here. They've recently created an independent investment board to invest their Social Security trust fund in private sector securities. While they won't begin to invest the trust fund until early next year, their deliberations, I think, will prove informative. Lastly, while investing the trust fund may minimize risks to individual investors, I think it may have large-scale market effects. It's impossible to predict, but I think it does raise a number of potential issues. Would the government have an ever greater incentive to use these funds to control market fluctuations, if not the market itself? How will the possible increased demand for equities affect the level of corporate investment and its distribution across sectors of the economy? And how long will it take to affect rates of return on different assets? Again, after hearing all of these questions, some of you may be reminded of this line: question everything, learn something, answer nothing. I would agree with the first two, but this debate simply doesn't allow us the luxury of the third. In the last 70 years, America has experienced two striking trends: the dramatic reduction in the poverty rate among elderly Americans and the remarkable, extraordinary growth of our capital markets. These developments in no small way owe their existence to the Social Security Act of 1935 and the Securities legislation of 1933 and 1934. Today, our nation faces an historic choice. Should we meld the protection of Social Security and the vibrancy of our markets? And I can't help but marvel this evening. I come to Harvard to speak about this very issue. If the founding fathers of the SEC still inhabit the courtyards in the building of this great university, I hope they're taking note. Without their passion to put investor interests first, our markets would not be as fundamentally strong and as fair as they are. And I doubt whether anyone would seriously consider investing one of America's most popular and successful anti-poverty programs into our markets if that were not the case. As the SEC begins to examine different Social Security reform options, I pledge to you that our commitment to investor protection will be paramount. We will bring that focus to the table as the discussion proceeds, whether at the White House conference in December or in any other venues. I have asked Commissioner Paul Carey, who is with us this evening, to lead the effort to harness the Commission's resources so we can effectively advise lawmakers. Whatever the eventual outcome of this policy discussion, the Commission will continue to aggressively combat fraud, promote investor education, and diligently work to ensure that our markets remain the most resilient, innovative, and transparent in the world. Thank you, and I'd be glad to answer any questions.
There are microphones on both sides of the floor. We'll alternate. Why don't you start here?
Thank you. Hello, Mr. Chairman. It's a fair guess that the Congress which passed the Securities Act of 1933 did not contemplate the internet. But hedge funds may solicit non-U.S. persons directly over the net. In short, the information is out there for all to see, including Americans. Hypothesis Macro Fund is an example. How can the Commission perform its historic role of investor protection in a world where any American home can tune into a website of an offshore hedge fund, such as Hypothesis, use an offshore vehicle to purchase, and thereby opt out of U.S. securities laws?
I think ultimately no agency of government can possibly eliminate all fraud in our markets or any place else. What we can do is try to root out those cases that represent the most prevalent kind of frauds in the country and to publicize them as widely and broadly as possible. The internet has opened up a whole new means of defrauding investors. Hardly a day goes by, those of you that surf the internet will see these unbelievable offerings that come over there. With one I saw last week was 300% a year guaranteed. Guaranteed by whom? We had a case not too many months ago of someone who raised over the internet $12 million for a non-existent eel farm. Well, like anything else, we have to respond, and we're bringing more internet cases than before. But while the internet offers an opportunity to defraud investors, it also offers an opportunity to inform investors, to warn investors. It also is out there so we can see it. And we have a program of monitoring the internet all over this country, and I have spoken to my counterparts all over the world to do the same thing. So it's a challenge for us, clearly, but it's a challenge that I think we will meet in a pragmatic and an electronic fashion. And I think if I weighed the benefits versus the liabilities of internet usage in terms of investor protection, I'd say that the benefits vastly outweigh the investor dangers. I recognize what you're saying, but I think the opportunity to warn investors, to advise them, to teach them, and to observe what's going out there is one that we can easily and comfortably work with. Yes?
Mr. Chairman, I have a question about the regulation of hedge funds. As we saw recently with long-term capital losing a tremendous amount of its equity, a lot of people questioned the appropriateness of the Federal Reserve Board intervening and playing a role as helping to bail out, where the partners at long-term were able to take $5 billion and lever up to $120 billion. That's a very little amount of collateral. If the average American went to a bank with that small amount of collateral, they would not be able to lever up that high. So I wanted your opinion if you felt that we would be seeing some fairness in the system in terms of large investors and the average American if we actually regulated hedge funds.
Well, long-term capital and its resolution has created a perceptual problem in this country in terms of what is perceived, and you well stated it, as the fairness of treatment, where large investors appeared to be treated in a better way than a small investor would under similar circumstances. If you accept the notion that has been put forth by some of the participants in that affair, that the unwinding of long-term capital would have created a systemic risk, a risk to our markets that could have worked to the detriment of America's investors, then the means would have justified the end. The Federal Reserve Board did not use federal funds to bail out long-term capital. Rather, they convened the participants. They convened the lenders and said, lenders, we'd be better off if you work this out than if you just let them dump their positions on the market. Now, would I have been happier to see a private sector solution to this where Warren Buffett and his colleagues had succeeded in buying long-term capital? Probably. But again, no taxpayer funds were involved here. The result was relatively orderly. I can't say whether systemic risk was involved. This is something that we are studying in the President's working group, and we will report back on that within the next few weeks. As far as regulating hedge funds is concerned, it's easy to say, but rather difficult to do. Hedge funds are sophisticated clusters of a limited number of participants. They could just as easily do business in Jakarta as they can in the United States, so that for us to impose regulation would clearly drive them overseas, and unless we could get some kind of international agreement on monitoring what hedge funds do and how they operate to prevent their raising the specter of systemic risk, our unilateral action would be totally ineffective. I think what we saw in long-term capital, however, was a failure, a supervisory failure. The banking supervisors and regulators simply should not have allowed the banks to lend as much as they loaned to any one entity. The discipline of the marketplace has created a backwash now where many lenders now have close the door on lending, and that has impacts that can be even more negative than over-lending. The answer to all this is, I believe, greater transparency. We simply must break down the secrecy of the hedge funds. And we must know, the banks and the brokerage firms must know what kind of obligations borrowers are undertaking before they extend additional credit to them. The answer to this is not regulation of hedge funds. The answer to this, in my judgment, is greater transparency. Yes.
First of all, Mr. Chairman, I'd like to thank you for your lucid and interesting comments this evening. And then second of all, in terms of your focus seemingly being, are investors ready for the market? And I guess my thought as I was sort of sitting there over in the corner is the market ready for this many investors if we significantly privatize Social Security? And here's the hypothetical for those folks at the Kennedy School of Government. 20 years from now, you got millions of more people invested in the market. You know, perhaps there's a significant market correction. Perhaps millions of people need to start shifting funds out of the market to more liquid investments as they get ready to retire. And there's a severe correction. And you've got every single congressman, all 435, with their phone ringing off the bloody hook, people screaming, "You bloody blah, 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 my Social Security just went down 10%. What are you going to do to fix it?" And 435 congressmen trying to figure out how to either stabilize or raise the stock market and its impact on potentially on the marketplace, its impact on regulations, and whether we might in fact end up shooting ourselves in the foot if investors aren't ready for this kind of responsibility.
I think that the specter of 435 congressmen doing almost anything is kind of awesome. But what we're talking about is cultural change. And this country has absorbed a culture of investment and a culture of risk. We have more investors in our market today than we have depositors in our banks. And we're accustomed to investing, and the results of a 15-year bull market has been to bring that many more investors in. And one of the beauties of our system is that before we go down this road, you will hear so much debate back and forth from many of those 435 and from other politicians who are trying to take their seats that I think the country will know the risks and the rewards. And I think because of having a culture of investment, we will be able to sustain that. Now, I go on to say that I'm not necessarily supporting one plan or another. Personally, I think we're clearly heading down a road to some form of investment or other, but I think that this is a national dialogue which will be the major focus of discussion in this country for the next 3 years, or certainly until the problem is resolved, maybe a good deal longer. Some have said that we won't address this problem until several months before 2032. I hope that's not the case because, as Chairman Greenspan has said, every month that goes by makes the solution that much more difficult. But I am not fearful about Americans being able to understand market fluctuations. And one of the benefits of seeing a market reaction in recent weeks and months is to have this universe of new investors understand that markets do go both ways and that there is risk in every kind of investment, including government bonds. So that's clearly something that we have to contend with. But I think we're able to do it, and it's important that we prepare for it. It's important that we phase this in as a transition rather than doing it overnight. Yes.
Well, I think I want to continue on with the question you just answered. I must say your remarks tonight I found rather depressing, and I understand why you have to do your job and why you're interested in educating people about these risks and so on, but frankly, over the last few months, as I watched my own investments go down, I thought the one consolation was we were going to kill this idea about privatizing Social Security, that it would lose its political salience.
I gather you're against it.
I'm against it. And, to the extent that I haven't concentrated on it, but to the extent that I've thought about it, I'm against it because particularly of the poor that you're subsidizing, there's a big income transfer that goes on through Social Security.
What have I said that depresses you, though?
It seems to me that it's very dangerous for the reasons that you've outlined.
But I'm not espousing that.
Well, let me ask my question then, is that in between what you have said, the lines that you have said, is that we shouldn't do this at all, that we're going down the wrong road, or maybe if you think it's the right road, you could persuade me that we really should be going in the direction of privatizing Social Security and assuage my fears, because I think it's a very dangerous situation for the reasons that you've talked about and some of the questions we've already heard.
I guess I think that in terms of the political debate that is developed today, if you looked at America from the moon and said, those 435 people are going to have to wrestle with the question of cutting benefits, raising taxes, or developing a new way for Social Security to fund itself, a magic bullet, if you will. You'd have to know the probable direction of those 435 people. They hate raising taxes. They hate cutting benefits. Now, how far will they go and what will they do? Because I think that some of the plans that I've read are less draconian than others. I think that in an issue as loaded as this issue, the only way to arrive at a sensible resolution is to consider every alternative without prejudging them. My concern tonight is not to espouse one or the other, but to say that every bit of energy I have, as long as I'm in Washington, will be dedicated to protecting investors if we follow any of these alternatives. If we stay where we are, if we move in another direction, I want to be certain that investor concerns are heard, that every one of those 435 and others who play a role here will listen to investors, and I will try to mobilize investors, and I will work with labor unions, I will work with corporate groups, I will work with AARP and every other investor group to see to it that their voices are heard in the councils of those decision makers who are going to make this decision.
Good evening, Mr. Chairman. My name is Brian Klett, and I'm a second-year policy student here at the Kennedy School. You spoke about the dangers and costs of having millions of decision makers involved in the savings program for the future. My question is about the other extreme. If we have a very limited number of decision makers or a limited number of options, will that lead to an inefficient allocation of investment funds? And if so, is it predictable what that cost will be?
Well, I think the cost would rise with the number of choices, almost by definition. I think that if you limit the number of options, I think the decision-making process at first blush would seem simpler, but I don't believe there's one suit that fits all in investing. And I've always, when I counseled clients, I urge them to consider diversification. Almost every investment counselor in America will talk about diversification, and I think the impact of market fluctuations would be felt much greater in a narrow, if there were a narrower list of options available to investors. Yes.
Yes, you talked a lot about educating the individual investor. I think you mentioned 40% of the average investors don't know the difference between a stock and a bond. My question is kind of getting back to long-term capital. Supposedly those were very bright, well-informed investors that took risk and they took the wrong choices or whatever and they lost a lot of money. If those people don't understand market risk, how do you expect the actual individual investor to understand market risk? Do you think the market risk have become too great and that they should be, that they're too great and that we should do something about lowering market risk?
No, I don't think market risks have become too great. I think, in my experience, when people think they best understand risk and can challenge risk successfully, that's when they have the greatest problem. Some of you may remember in 1987 we used to have something called insurance. Insurance would guarantee against market fluctuations. It was the holy grail. We found a way to beat the market. And then guess what? 87 came along, program trading hit with a vengeance, and insurance died. It died in 3 days. In the past 3 years, we've seen some of the great gurus of America talk about new paradigms. Graham and Dodd were no longer the factors to consider in terms of investments. We have something new going on in America today where we are able to successfully challenge risk. Guess what? Long-term capital came along. Systemic risk reared its ugly head. Markets are, by definition, unpredictable, and if they were predictable, they wouldn't be markets. And I think that Americans are smarter today in terms of investments, even with that 40% number, better educated today. We have better communication today than ever before. Our system is basically sounder than ever before for a number of reasons. So I think if we try to manage risk, we won't succeed. There are too many ways of, people are too willing to waste their money on get-rich schemes. And you're not going to change the American personality, but I think that a sound program of disclosure together with greater transparency is the best way to address any level of risk. Yes?
Hi. You mentioned this business, which is literally a business, this culture of investment and the educational responsibilities that will go along with that. I wonder if there's another way of thinking about that in terms of a culture of ownership, that it's more than investing, it's really ownership that goes along with that. And I guess my question is your thoughts as we move into a different era. The OECD has recently come out with a statement on corporate governance, looking at some of the standards that might be considered in terms of the way in which corporations are governed. That's an issue for shareholders to think about in terms of the role that they play. And I wonder, as the SEC is faced with broadening its definition of what's allowable, certainly in different proxy resolutions, have you thought about the interplay between good ownership, good governance, and good citizenship? And is there or might there be an ethic of ownership that is compatible with an ethic of governance and citizenship that recognizes that there are certain sort of normative standards by which corporations might be held accountable that affect our investments and our quality of life?
I think that's a very good question. I haven't been asked tonight, but I've been increasingly concerned about the way corporations report to their shareholders in an era where I see more and more accounting gimmicks being used to distort what companies are doing in the year that they are doing it. And in connection with that, I asked John Whitehead and Ira Milstein, who headed the OECD effort, to report back to the Commission within 90 days on a program to improve the role and the importance of the Audit Committee in terms of rooting out distortions that exist in the way companies report to their shareholders. I think so much of this has to be a private sector initiative with the SEC and other agencies serving to nudge the process rather than to regulate the process. the cost of regulation is awesome, and the ability of corporations and others to circumvent regulation that they don't agree with is almost legendary. And I'd rather seek a consensus from the many people in corporate America that recognize their strategic interests are well served by governance that develops the culture of ownership that you speak of. And I am very, very enthusiastic about that and very supportive of such an effort.
Two more questions, one from each mic.
My colleague found your comments depressing. I found them reassuring.
Great.
I think that your emphasis first on investor interest coming first, transparency and integrity in education. I probably, as an educator, have slightly less confidence in education, our ability to get every American to understand investments the way we would like them to at a rudimentary level. But I want you to comment on a metaphor. Another area where people have a very poor understanding is medicine, and particularly pharmaceuticals. And it's probably, you could argue, is just as important as how they invest. But yet our government has worked out a very successful system where it regulates various products. We have professionals as intermediaries who put them on the market. People consume products not having the slightest idea of what they're knowing. And we do have a quack medicine industry which nibbles around the edges and causes us discomfort. But it works very well. Most people say it works much better today than it did 15 years ago when it had a much stronger regulatory hand. It has many of the problems you talk about. We managed to get drugs to poor people. The administrative cost for examining someone and administering a prescription is certainly as high as sending out a few pieces of paper, and it works just great. So I'm wondering whether you think there really is a significant potential for the government regulating funds or providers and regulating their fees, regulating the disclosure requirements, and having a system of the type that's been proposed actually work fairly effectively if done in conjunction with a dispassionate SEC.
Well, I think every industry requires different kinds of oversight. The framers of the securities laws and successor generations have developed a system of regulation based upon self-regulatory organizations, enforcement action by the commissions that punishes bad practice, and very importantly, private rights of action. The combination of those three, I think, have given us the best regulated, most efficient markets in the history of the world. I'm not sure overlaying any additional regulatory structure domestically would be productive. What worries me most, however, is how we interface with our very significant counterparties in other parts of the world that do not have cultures of transparency, do not have a regulatory regimen that enables us to deal with them on a comparable basis. And it's in that arena, most particularly with respect to accounting standards, which are so fundamental to protection of investors, that I think we have the greatest challenge.
Mr. Chairman, I'd like to return to your comments about the need to help investors understand risk, particularly with the comment about nudging the private sector rather than telling them what to do. I know that over the years the SEC has tried to encourage the mutual fund industry to come up with some comprehensive measures of risk that they could use to inform investors. I'm just wondering what the progress report is on that effort.
Starting 2.5 years ago, I badgered our investment management department to come up with some formula for assessing risk. And they worked with the industry and came up with a variety of formulations, none of which really worked well. Standard & Poor's then came in and said, we've got a way of giving you a comparative risk assessment of money market funds. We want to use that. We want the NASD to agree to let us use it. And the industry said, no way, that would be a terrible thing. It would mislead investors. And I said, I don't care if it is misleading. investors should have what they want, and let them be the judge. Let somebody else come up and give a competitive valuation if they feel that Standard & Poor's is inaccurate. And after nearly a year and a half's fight, Standard & Poor's is going ahead and they're going to evaluate money market funds on a trial basis. I'm going to continue to push the industry and push our staff. I'm about to hire a new head of our investment management division, and one of the mandates will be, please try to address this issue of risk management.
Thanks.
But it is an important issue, and you're quite right. It's the question I am asked most frequently at town meetings. How can I compare the relative risk of Fund A with a wonderful name like government or guaranteed resources against Fund B with another glorious name such as secure? And
Absolutely.
thank you very much.
I'm sure all of you will now understand why the Senate Banking Committee was unanimous in its reaffirmation of Arthur Levitt for his second term, and we will welcome him back to the Kennedy School anytime he wants to speak or when he wants to rejoin our visiting committee. Thank you again.
What we should do is take these names, and I think we will accept.